What are the top 5 stocks you are currently most bullish on?
I mean, there's so many companies I'm bullish on. I probably own 25 stocks or so. And there's probably another 10, 15 stocks that are on my possible second quarter buy list. So there's always a lot of stocks I'm looking at and whatnot. So it's hard for me to say like this stock or this stock. If I think about some of the stocks that, if I was to think about easy money stocks, let's say for instance, okay, easy money stocks, for that group, Meta comes to mind first. Like the stock, if I just think about an easy money stock, Meta comes to mind. Facebook still growing, Instagram still growing, WhatsApp still growing, right? And WhatsApp is really just starting to reach some sort of scale in relation to their revenue growth. And WhatsApp has, oh my gosh, like 10 plus years of just massive kind of revenue growth opportunity there. Instagram Reels has been taking off like crazy as far as a product. Now they're going to play catch up in terms of the advertising business catching up to where Instagram's going here. And so Meta, I mean, their balance sheet, their businesses, obviously the metaverse is a big opportunity, but even if they didn't have the metaverse, if they cut that out, people got to understand Meta's spending over $1 billion a month right now, over $1 billion a month on the metaverse. So they're in a no-lose situation. If metaverse is huge, they're likely going to be the biggest player there, or certainly one of the biggest players there for metaverse opportunity, VR, AR. If it's not, and let's say they have to get out of the business, that's an extra $1 billion plus a month. That's going to end up hitting the bottom line because they could just get out of the business and fire those employees that have been working on that and either spend that money somewhere else or just have it hit straight the bottom line. So I actually look at that as like a tremendous kind of opportunity there from different standpoints. So I absolutely love Meta. Amazon's my number one stock I'm really focused on buying in 2023. Tesla could definitely be on my radar as well as a stock I'm definitely considering. But Amazon, I love. AWS, you have obviously the e-commerce business, which, if I had to ask somebody, they don't have to be a business genius, but like, when does Amazon, the e-commerce business, stop growing? I mean, my gosh, I don't know. I don't think it's in this decade. Maybe it's in the next decade. Maybe it's in the decade after that. At some point, Amazon's e-commerce business will start declining, but I don't know when that is, but it's so far from now. Can't even imagine it. AWS, Amazon Web Services, is still very early days. That's another one of those businesses that, when does AWS stop growing? I mean, I don't know. It's so far from now. It's 10, 20, 30, 40 years from now in terms of that business stop growing, right? Their advertising business continues to take off. And they just continue to push that business. And Andy Jassy, who's leading the company, when I listen to that man on a conference call, he's really got down the Bezos mindset of, when you hear that man talk, he's talking about building relationships with clients that are going to last way past his time at the company. That's the type of mindset I love. When people are thinking about legacy, when people are thinking about where's this company at when I'm not even on this earth anymore. That's the type of stuff I love. And I can tell you, Amazon's one of the very few companies that thinks that long term, because I can tell you most of these executives out there, they're thinking about their bonus check. They're thinking about the next year, and that's about it, because they know, they're only focused on what's going on with the next year. They're not thinking about the next 25 years. Okay. So I love them. In terms of Tesla, is definitely an opportunity this year, which is 2023 is a year that's going to mark an opportunity for Tesla stock investors to buy that stock at, very discounted prices. And that's not a stock that usually trades at discounted prices. And so those are some of the companies I think about first. There's a lot of opportunities in value stocks and dividend stocks. And, I know those stocks aren't the sexiest. Like they're no Shopify's, they're no Teslas, they're no Palantirs, they don't have those sorts of revenue growth opportunities in front of themselves. But a lot of those stocks are trading at very cheap valuations. If I think about a company like Whirlpool, I'm actually considering buying that one. I haven't bought it yet, but I'm considering it. If I think about a stock like WBA, Walgreens Boots Alliance, now they don't have the boots business, or they do have the boots business now, the Alliance business now. But if I think about that company, such a low, cheap dirt valuation, it's going to be stable regardless if there's a recession, good economy, bad economy, pays out a great dividend yield. So I look at a stock like that. I look at a stock like Foot Locker, falls in the same category. They just always put up their numbers and always do very well. They're cost cutting right now. A lot of these businesses are cost cutting right now. It's going to help their profitability as well. So I think there's tremendous opportunities out there. From spec stock sides, I know everybody wants a spec stock or two. I think a couple that come to mind are Honest. HNST is a spec stock that I think is got a tremendous long-term opportunity. We'll see what happens there. Fubo is another spec stock that I think has a big long-term opportunity, but they've been taking huge losses. So a lot of people don't want those sorts of companies right now. So there's really a lot of opportunities in the market. It just depends on where you want to look. From the growth stock side, there's some. From the value stock and dividend stock, there's even more. And from the spec stocks side, I've never seen so many spec stocks trading so cheaply in my time in the market, which I got in 08, 09. I mean, I can tell you for the past 10 years, there's been a lot of people that want to be in a lot of spec stocks, right? And I've never seen this many speculative stocks that kind of fit those. Well, they got this big opportunity long term, but they're losing money or we don't know about them. I've never seen so many trading at 50 cents, $1.50, $1, $2. I've never seen this amount ever. This is a different time period, but also since I've been investing, we've never seen Fed funds rate of 5% or 5% plus. So we're going through a different time period. So yeah, there's a lot of opportunities out there in the market. And I think investors are getting too caught up into the game of trying to time things out perfectly and thinking they're macroeconomic experts when there's a tremendous amount of opportunities in the market. As long as you have more income than expenses, you're always in a position to buy. As long as you have more income than expenses, you're always in a position to buy, whether it's every week or every 2 weeks or once a month. And so you don't have to fear a crash. And if you're a sophisticated investor with a lot of money in the market, then you can always hedge. I have different hedging strategies I utilize. So if the market does tank in any way, I'll make bank on the market tanking. The bottom line is people got to focus on the long term with these companies and building out these positions to very nice sized positions that they're the type of stocks they're happy with for the next 5-10 years. Be careful with call options. Be careful with margin. Don't mess around with that stuff, because if the market tanks in any major way and you're super heavy margined, your account's going to be disaster zone. You could end up going belly up in that situation, which is, you got to survive the bad markets and then thrive in the great markets. Put yourself in that position.
So your style is to build a high level of conviction into any of the stocks you're purchasing. You're obviously a long-term investor. How do you manage the diversification around that? You said Amazon this year is a company you'd love to be loading the boat on. How heavy into Amazon would you be willing to go? And just from a general portfolio point of view as well?
Yeah. So, in terms of diversification, so I like I said before, I probably own roughly 25 stocks right now. And then I own a couple of ETFs that are kind of like hedges basically on the market. So I build out a very well diversified portfolios that consist of many stocks in many different industries and can fit kind of my strategy, which is GVD, which is growth, value, dividends. Growth, value, dividends, and owning all three of those groups of stocks, because some people just own one group of the stocks and they just miss out on a lot of opportunities. Think about it this way, right? If I want to become the best boxer in the world, okay? As I probably should have started when I was like 3 years old training, but let's say I want to become the best boxer in the world, right? It's not just about throwing a haymaker and trying to hope your punch connects. The best boxer in the world of our generation was Floyd Mayweather. And that man knew how to throw punches and avoid punches better than anybody we've ever seen, right? It's about being able to be defensive and then being able to take those offensive opportunities and taking advantage, right? And look at the same thing in the market. If you're only a value investor, you're limiting yourself to a very small segment of stocks in the market, right? And there's certain time periods when value stocks get very overvalued. And then you have no opportunities in the market. If you understand dividend investing, value investing, and growth investing, you have such a wide amount of stocks to invest in, because now you have so many opportunities in front of yourself that you can look at and say, you know what, there's 5,000 stocks in the market or whatever, but these are the 5 that I actually care about adding to positions. Now, in terms of position sizing, if I look at something like Amazon, so as a position that right now I probably have maybe $70,000 or $80,000 in the public account. For reference, a stock like Meta is over a $400,000 position in that account. So for something like Amazon, I would love to build that out to maybe a $200,000 position, something like that. Do I have as much confidence in Amazon as I do Meta for the next 5-10 years? No. But do I still have a tremendous amount of confidence and want to build it into a nice size position? Absolutely. But that's one of the biggest things that investors need to understand, whether they're a newer investor in the market or even experienced, is building out a 10, 15, 20 stock portfolio that you're happy with. Because there's a few things that I've seen take people down and end them in terms of the stock market. One is margin. The other is trying to play short-term calls and puts, and their accounts just getting devastated because they thought the market was going to tank or skyrocket in the short term. And the third thing is under-diversified. I've seen so many people be all in 2 or 3 stocks. And one of those or 2 of those stocks don't work out, and next thing you know, their portfolio is wrecked forever, right? If you're wrong on a stock, it should hurt you. It shouldn't end you. There's a big difference. In the past 15 years, there's been plenty of stocks I bought that didn't work out. None of those stocks ended me. They hurt my portfolio. They hurt my account in the short term, but they didn't put me out. That's the important thing that people got to remember. And so, make sure you're building out a great portfolio, 10, 15, 20 stocks, and learn all the different disciplines: dividend, value, growth. I started out with being a value investor at first. I was learning kind of the Buffett principles. And then as the years ticked on, I started understanding more and more about growth stocks, how to value growth stocks. Because when I first got in the market, if I looked at a stock that was at a 20 PE, I was like, I can't buy this stock. It needs to be a 10 PE. At a 10 PE, or I can't consider it, right? If you're a growth investor, you're never going to get a 10 PE, okay? Tesla's not going to trade at 10 PE. Amazon's not going to trade at 10 PE. That's not the way it works. So then you have to learn, how do I value a company that's going to expand their market rapidly over the next 5 years? How do I model these numbers? And then you start getting into revenue growth rates and how much of their revenue is realistic to hit the bottom line. What have they done over the past few years? What do you think they're going to do in the future based upon this industry? And that's when you start to get in a lot of the nuances of investing, which is some high level stuff there. But yeah.
Do you watch the All In podcast?
I've seen a few episodes. I don't watch it regularly, but I've definitely seen a few segments from them over time.
So in the intro, David Sachs has a line in the intro music where it says like, let your winners ride or let your winners run or something like that. And what he's referring to is, you could have made an investment into a company and it's up 10x, 100x. And his sort of point he's getting at there is, don't sell out too soon. Let it play out. How do you take that forward when you're trying to have a diversified portfolio? If something gets too big, but you really think we've only just started with this company and you're kind of like playing with the house's money now, will you let that ride or will you trim it? Or
my biggest regrets in the stock market in my investing life have not been the mistakes I made where I bought a stock and I was, so bullish on it and it didn't work out. Those are definitely regrets, but those aren't my biggest regrets. My biggest regrets always in the market are the ones that I saw everything coming. I bought the stock. It went up a little bit in the short term, meaning 20%, 40%, 60%, whatever. And then I cashed and I sold and I took my profits and ran out of that stock. I'll give you a good example of that, a real life example. Elf Cosmetics. This was this company that I saw when it was like a $7, $8 stock. And I'm like, oh my gosh, this is a tremendous opportunity. I think this company's going to change for the better. I think they're going to I bought in that stock very heavily. And I think at the peak I owned, let's say maybe 10,000 shares or so between my different accounts. And things started to play out the way I thought they were going to play out. And the stock started to go up and up and up and up. And I took profits all the way down to only 1,000 shares left. Well, that stock as of today is up 1,100% or so since I bought it. And I sold out most of my shares before the stock had even 2x'd. The stock has over 10x'd, and I sold most of my shares before it even 2x'd. And so that's one of those stocks I look at and I'm just like, I saw it all coming. Everything was playing out and I was so quick to take profits in it. What a epic mistake. And I've done that with plenty of stocks over time, including Monster Energy, including, if I think about Cirrus Logic, like this, there's a long list of stocks I've done that with over time where I started taking profits way too soon. That's the hardest thing as an investor is letting those ones ride and just the companies that you see executing, let them execute. Let them put up their numbers. Let them do their thing. Don't be so quick to take profit. If it's really a great long-term investment, you really don't have to, right? Plus, you're running out there to then take massive gains, which then means massive taxes. Are you really in a rush to take those massive taxes as well? So it's definitely something that I've had to learn the hard way over the past 15 years or so, is letting those ones ride. Now, in terms of diversification and whatnot, I don't really think about it in terms of if a stock goes up a bunch, it becomes a much bigger weight in my portfolio. I think about it in terms of what I'm buying in with, the amount of money I'm buying in with for that stock. Because if I, build out a position to be 50% of the portfolio, but it's because I put money in it, that doesn't make much sense. That's way too risky. If a stock went up so much that it became 50% of the portfolio, that's perfectly fine because it went up so much to become that, not because I put that much money in it. So a good example of that would be something like Tesla. Tesla became a big weight in the public account over time, not because I put a ton of money into it, just because the stock went up so much. And so that's kind of my thinking around that. But it's a hard thing to see, you up 40%, 80%, 100%, 200% on stock and not be like, I got to take profits. You really have to then look at the stock, look at the valuation of the company, look at the forward PE. What do you expect the company's profitability to go to over the next few years? Not what it was a few years ago. It's about where it's going over the next few years. And, at the end of the day, how much is up or down is actually irrelevant. It's really about looking at the current valuation the stock's at that time and saying, is the stock still a good deal? Is the stock still good to hold? If it's super overvalued, that might be a different situation. If some stock went up far too much and you're like, oh my gosh, like it's going to take the company 5 years to even grow into this valuation, that could be a different situation. But those situations are few and far between.